Hello, welcome back, guys. So, Pubmatic is a SaaS company that is super trending today. It is up 24% actually currently as I'm making this video. Now, we're gonna talk about the reasons why this is happening right now and whether this is a good buy. Is of course a question that we all wonder about. And this is a company that has been at about 43 bucks about a year ago. That was its high. Right now, it's about 50% that. And if we take a look at the 5 years chart, you will see that it's basically been going down. Now today, with this 24% increase, we're getting a significantly higher price than what it used to be, but it could still be an interesting opportunity here. If you take a look at the social trends, you will see that this one is massively trending right now. You will see that the sentiment is super positive and lots of posts and likes and impressions in stock tweets where all of these stocks are actually discussed live, and it makes the most sense in terms of trends. So yeah, lots of action here going on with stock tweets, but let's take a look at the company itself and the news. Like what happened? You will see why Pubmatic stock soared on Tuesday. Let's take a little bit of a look here because this is interesting. Now, you will see the AdTech company's debt-free business, which is another interesting thing, is firing on all cylinders, and I love to hear that, obviously, if I want to be buying this company. Now, the tech company backed a trend of decelerating growth seen by many of its digital advertising peers. We have seen lots of companies, Google, Facebook, lots of companies, frankly, Amazon. Actually, Amazon did better, but still, they were having troubles with advertising. Things were looking worse than what they were looking like a year ago. So Pubmatic provided guidance for double-digit third-quarter revenue growth, a growth rate well ahead of the decline forecast by Facebook, for example, which we examined, and the guidance for low single-digit growth streaming platform Roku. Okay, so what here is what the article is asking themselves actually. So Pubmatic's second quarter revenue increased 27% year over year to 63 million, which is pretty nice to see, an acceleration from the previous first quarter year over year growth of 25%. So even at this current environment where you would think things would be worse for the company, they're actually better, and they are increasing at an even faster pace, which is impressive, frankly. So net income for the period was 7.8 million, or 12% of their revenue. Total cash or cash equivalents pretty much and marketable securities was 186, while they don't have any debt, which is another very, very interesting thing, of course. And the CEO said that these growth rates were well ahead of market growth rates. Yes, that's true, and he is right, absolutely. Quick look at Meta's second quarter year-over-year revenue decline of 1% and Roku's platform revenue growth of 26% confirms this view. Absolutely, yes. So yeah, we are looking at a company that seems to be doing very well, and it is a software that seems to be connecting advertisers and publishers. A very, very interesting one, and I kind of like this software as a service that basically tries to make people money. So make money for advertisers when they can actually advertise their products and gain more money, and for publishers who can actually make money on advertising. And so when a product actually connects groups of people who both are winning from this pretty much exchange, I love to own such a company, especially if they're doing well, of course, because they are sort of like an intermediate on a win-win situation, and of course they can be doing very, very well through the ages, through the years. Now let's take a look on whether this company is cheap or expensive, though. You will see that the PE ratio is 22%, the price to free cash 22.6, sorry, the price to free cash flow 23, so very close to each other. You want to see that. You do want the PE ratio and price to free cash flow to converge as much as possible. And the thing is, they are an X here because the software will automatically give you an X for anything about 20. But remember that growth matters a lot, and net income, for example, margins matter a lot as well. Returns matter too. Debt matters as well. So lots of more things matter, and it's not only these numbers that will decide whether we should be buying this stock or not. First of all, the revenue growth has been tremendous, and I like to see this kind of chart where things are going upwards at a steady pace, and or even more like exponential pace, frankly. And net income growth that has been exponential, and free cash flow growth that has been pretty awesome as well, with total equity growth that has been great too. But that's probably my biggest thing about this company. The outstanding shares count, they have been diluting shareholders since the IPO days massively. Now that does make some sense when you are IPOing for the first time, and I do appreciate the fact that this is much, much less since 2021, the dilution. But yeah, this one, the people who bought here have been massively diluted. I wouldn't love to see that, but again, as a new shareholder buying at this level, I may expect a little bit of an extra dilution here, but they seem to be showing to me that they are more than likely going to go for something like 5 to 10%, which is still dilution, but it's definitely not 300% what they have been doing so far, which of course has been way too much, understandably. Now, the company, in terms of liabilities here, they have 5.9 years of last year's free cash flow, pretty much, which is fair. It may be a little bit more than you would want, but not necessarily bad here. But as you see, debt to equity ratio is basically almost zero, and everything else is looking pretty nice. Return on equity nice as well over here. Capital employed, returns, and all that looking great. Now, let's examine the financial statements just to see the pace of this company, how much it has been growing through the years, pretty much. Revenue, 99 million to 226. Pretty awesome growth here is what we examined earlier. And in terms of net income, 4 million to 56. Again, green all over and increasing. I love to see that, of course. And whenever these kind of financials are basically coupled with a cheap stock price, it may be a fantastic opportunity, frankly. Now, in terms of the balance sheet of the company, you expect additional paid-in capital here, which is in the positive because the company has been diluting shareholders. We saw about that earlier. They have been diluting shareholders quite a lot. And in terms of total equity, they are at 257 million, while the total liabilities are a little bit more, about 300 million here. If we take a look at the cash flow, which really matters to me over here, I'm looking at a company that is positive in terms of net income, but I do want them to convert their operating cash flow to free cash flow over here. And they do make some operating cash flow, 88 million here. When factored for capital expenditures, you are looking at about 50 million in terms of free cash flow. Last year was marginally negative, before that was 20 million. That's fair, especially for a new company. You will be seeing some ups and downs, but overall 50 million for its free cash flow, which is about 1/6 of their total liabilities, is what we examined earlier. If we take a look at the stock analysis page again, the metrics, you will see that this is a company which is valued at about $1 billion, which is again about 23 times its free cash flow. It is a little bit much, yes, but remember, we are getting some nice things here. We're getting a company that's growing nicely. We're getting a company that doesn't have a lot of debt, and a company that has pretty great margins that keep increasing also. It's something that is another good thing to see here for the company. And also they seem to be thriving in an environment where advertising is actually not doing that great if you examine all the well-known companies, really, and if you compare it to them. Now, granted, this is a much smaller company than Meta, for example, so you cannot really directly compare the two, or Google, but it still tells us a few things about how the market behaves when this company is factored in as a piece of the overall market. So they seem to be doing better and better, and I appreciate that. Now, we will use our stock evaluation tool because I do need to know whether this company is worth buying at its current valuation, at its current price. Now, it has been growing tremendously, right? You will see that the 5-year revenue growth has been 20%. It could have been better, but the thing is, there were some years where things were worse, like, for example, over here, 2019, and after that, they are reaping. And so, even if you go with a 30% revenue growth, which of course is a lot, and it's it's very aggressive, it could happen. It's not out of the question. And, for sure, it could happen. Now, we won't go that high for our first one, at least. We'll go 15. Let's just go 25, and for the last one, let's just go maybe 35 even. So let's try these different scenarios and see how they are at play. So in terms of net income margins, again, the company's average has been 13, but it has been increasing a lot, from 5 to 25 almost, and overall lately it's like 20, 21, 23, something of that sort. Again, this will be going up and down a little bit compared to from quarter to quarter, of course, but we will be using something that's between these two. I think this makes the most sense. The company seems to be pretty much grounding themselves around these levels. So I will be going at the low one, like 17, maybe 20 here and 23. And still, I think the company could do even better than this net income margin, frankly, based on what has been happening so far. Now, in terms of the free cash flow, we are looking at 87 last year, which I think is the more representative year of the company's doings, pretty much. So I'm going to go 80, 90, and 100 here, and the annual return that I want to get is 13%, my typical one, the one that I mostly ask for my stocks. And hit calculate here, you'll see that our medium and low estimates are still not there, pretty much because of the extra increase today. This is gonna be even higher, probably actually, potentially it could be even higher in the next few days, just because there is a little bit of a trend. But right now, as we are looking at it today with this current increase, and remember, before today's 25% or 26, whatever that is right now, this used to be at about $17, so this would be green. So it's only today that it actually surpassed this medium estimate here, and it's our high one that is at 35, which is much further away. But this one presupposes it's a 35% revenue growth, which is pretty steep, and it actually could potentially not even happen. So what am I doing with this company now? I think that my medium, my medium price to pay here, or my medium projections, are probably relatively fair, although I would likely want to go a little bit lower even. So frankly speaking, to tell you the truth, I think my price level would be near $15 for this one, somewhere in between these two projection results. I think is where I would get this company. I would want to get this company just because I'm getting a lot of extra nice things. It's the things that we discussed earlier: little debt, great margins, a company that's growing, has a lot of room to grow, and it's just not as expensive right now, and it seems to be doing better and better. So great things to see here, and it's a company that I'm going to be paying closer attention to in the future, especially if it gives me better entry opportunities. Right now it may be a little bit steeper than what I would want, but again, if it gives me a little bit of a better price, I may look to enter. But tell me what you think about Pubmatic. Are you potentially looking to enter yourselves? Tell me your opinion about the company. Leave a comment below. I'd love to hear it. And remember to leave a like and subscribe to our channel if you're not a subscriber. And also, you can become a Patreon and gain access to this tool. You can find links in the description box below this video if you're interested, or even join our Discord channel. Again, the links are below. Thanks for watching this one, guys. I'll see you in the next video. Bye bye for now. See ya.